Welcome to our quick dive into the stock market. Ever wondered how companies like Apple or Tesla raise money? Or why your uncle is always checking his stock app? Let's unravel the mysteries of the stock market in just 5 minutes. What is the stock market? The stock market is a platform where shares of publicly traded companies are bought and sold. Think of it as a bustling marketplace, but instead of fruits and veggies, you're trading pieces of companies. Where you buy a share, you're purchasing a small ownership stake in that company. Why do companies issue stocks? Companies issue stocks to raise capital for growth, research, or paying off debt. By selling shares to the public, they can access funds without taking on loans. In return, shareholders get a slice of the company's profits, known as dividends, and the potential for their shares to increase in value. Major stock exchanges. The two most prominent stock exchanges are the New York Stock Exchange and the NASDAQ. The New York Stock Exchange, located on Wall Street, is the world's largest stock exchange by market capitalization. The NASDAQ, known for its electronic trading system, is home to many tech giants. How are stock prices determined? Stock prices are driven by the forces of supply and demand, which reflect investors' perceptions of a company's future profitability and growth. Positive news, such as better-than-expected earnings reports or strategic acquisitions, often pushes stock prices higher as investor demand increases. Conversely, negative news like regulatory crackdowns or disappointing financial results can lead to selling pressure and price drops. As of October 2024, inflation concerns, changes in Federal Reserve interest rate policies, and geopolitical tensions have been significant factors affecting stock price movements. For example, when the U.S. Federal Reserve hinted at maintaining high interest rates longer to control inflation, the S&P 500 briefly dropped by 3% in 1 week, demonstrating how sensitive the market is to economic indicators. Key players in the stock market. The stock market is populated by various types of investors, each contributing differently to market dynamics. Individual investors, commonly known as retail investors, have gained more influence in recent years thanks to the rise of commission-free trading apps like Robinhood and Fidelity. According to a 2024 survey by eToro, retail investors now account for nearly 25% of daily trading volume in U.S. markets. Institutional investors, such as hedge funds, mutual funds, and pension funds, still dominate with their large trades that can sway market trends. Market makers like Citadel Securities ensure liquidity by always being ready to buy or sell shares at market prices. Their activity keeps markets functioning smoothly even during volatile periods. Types of stocks. There are primarily two types of stocks: common stocks and preferred stocks. Common stocks are what most investors buy when they think of investing in the stock market. Holders of common stocks are entitled to voting rights in shareholder meetings and may receive dividends, though these are not guaranteed. For instance, as of 2024, companies like Coca-Cola have continued their streak of dividend payouts, appealing to income-seeking investors. On the other hand, preferred stocks offer a fixed dividend and take precedence over common stocks in the event of a company liquidation. However, they usually don't come with voting rights. In uncertain economic conditions, some investors prefer the stability of preferred stocks, which can act as a buffer during stock market downturns. Stock market indexes. Stock market indexes serve as benchmarks that track the performance of selected groups of stocks. The Dow Jones Industrial Average, for instance, consists of 30 major U.S. companies and is one of the oldest indexes. Dating back to 1896, it provides a snapshot of blue-chip stocks and broader economic health. The S&P 500, representing approximately 80% of the U.S. stock market by capitalization, is considered a more comprehensive barometer of overall market performance. In 2024, the S&P 500 has shown strong gains, up by over 20%, driven by sectors like technology and energy. Global indexes like the FTSE 100 and the Nikkei 225 offer similar insights into European and Asian markets, respectively, making indexes a vital tool for tracking market trends worldwide. Bull versus bear markets. A bull market is marked by rising stock prices and investor optimism, signaling economic growth driven by factors like low unemployment and strong earnings. The last major bull market spanned from 2009 to early 2020, ending with the COVID-19 shock. A mini-bull run in tech emerged due to advances in AI and biotech. Conversely, a bear market indicates a drop of 20% or more from recent highs, reflecting pessimism and potential economic downturns. The 2022 bear market, fueled by inflation and rate hikes, resulted in a 25% drop in the S&P 500. Analysts cautioned that ongoing inflation and geopolitical issues could spark similar market trends. How to invest in stocks. Investing in stocks is easier than ever thanks to technology. Open a brokerage account on platforms like Charles Schwab or Robinhood, which offer educational resources for beginners. Research using tools like Bloomberg or Yahoo Finance to evaluate companies. Choose a strategy that matches your risk tolerance and diversify with ETFs or mutual funds. Use market orders for immediate purchases or limit orders for specific price targets. Risks and rewards. Investing in stocks can yield high returns, but it's not without risks. Market volatility, economic downturn, and company-specific issues can lead to losses. Diversifying your portfolio can help mitigate some risks. That's all for today's video. If you found this breakdown of the stock market helpful, don't forget to hit that like and subscribe button. Check out our other videos to deepen your understanding of personal finance and investing strategies. Thanks for watching, and see you in the next one.